So with the sustained high crude oil prices as well as the corresponding refined products, there's been some chatter in the space of the refineries. And there are a few refineries in Malaysia. One of them is a very old refinery that used to belong to Shell Refinery Port Dickson, now known as Heng Yuan. I'm going to share in this particular video what I think about the business model, whether they have any prospects going forward, what are the risks involved, and also perhaps some valuation on how to look at this business. So stay till the end to get my insights, my thoughts about this particular company. As a disclaimer, I'm not a licensed fund manager with the Securities Commission in Malaysia. Whatever I share in this video is purely for educational purposes only, and please make up your own opinion with regards to the facts I've shared. Do your own due diligence before coming to a decision yourself. So first off, what is their business model? They're actually a petroleum refiner in which they take crude oil and they actually go through what we call a distillation process, where they heat up this crude oil, and naturally, because of the temperature variation, it actually breaks down all these different hydrocarbon components that make up all your refined products. Things like your kerosene, your jet oil, your gasoline, bitumen, diesel. These are all the byproducts of a distillation process in a refinery. Now, crude oil on its own does not really make up usable products. It has to go through a refinery process before it ends up with the end user. That's where Heng Yuan is as a downstream refinery manufacturer. How does Heng Yuan make money? They make money through this thing called a crack spread. Now, what is a crack spread? It is actually the pricing difference in between your raw crude oil versus that of the prices in which you sell your refined petroleum products. So you buy crude oil per barrel. So where do you get a global reference? Usually these are priced in what we call WTI, or West Texas Intermediate, or Brent crude oil. And the refined products are usually priced accordingly based on the product, like gasoline, diesel, aviation fuel. They have their own market and their own pricing. So refiners earn the spread in between what they buy as crude and what they sell as a refined product. So earlier I mentioned about crude oil benchmarks. These are WTI or Brent. And for crack spread, there is one example shown on the chart. It's called the RBOB crack spread, New York Mercantile Exchange. What does RBOB stand for? It just stands for reformulated gasoline blend stock for oxygen blending. Now, it's very confusing. What it just means in layman terms is this: it is gasoline without MTBE, which is a carcinogenic, cancer-causing agent, and we know that as leaded oil. What we have today is unleaded oil, and gasoline without MTBE is actually unleaded oil. So as you can see, the crack spread has come down by quite a bit from its peak of about $31 to roughly about $19 today. So refiners will have a tough time if it maintains at this $19 crack spread as compared to when it was like $30, right? Now the struggle is this: refinery has always been known as a low margins business. If you looked at one of Berkshire Hathaway's holdings was Phillips 66, a refinery in the US, and on average, if you look at the numbers, net margins was anywhere between 5 to 7%, and that's considering a good year. So this limited margins really makes the business ruthlessly operational efficient, because that's the only place where you can play around with, because you are at the mercy of the volatility of your raw ingredients, which is crude oil, and you have to hedge, because whenever you buy your raw materials, you already have to hedge your selling price, because it has a mind of its own, it has a volatility of its own. And anywhere in between, you just have to be operationally as ruthless as possible to be able to maintain your margins. That is the challenge of a refinery business. Moving on to Heng Yuan's financials, revenue has remained kind of stagnant. 8 billion, 11 billion. They had a good year in 2019, about 12.6 billion. And as of financial year end last year, it was about 12.06 billion. No, 12.006 billion ringgit Malaysia. For the trailing 12 months of this coming to the most recent quarter ending, they are expected to be definitely higher, because look at the revenues being generated, 19 billion. So I think that's where the chatter has been ongoing about what will be the next quarter be. It is quite a substantial jump as compared to 2021, due to, I think, rising prices in crude oil as well as rising prices in refined product. In terms of net profit wise, I think last year they made 82.6 million, but cash flow from operations, quite commendable, 223.95 million, and they have been positive operating cash flow for the past 5 years. Kudos to them. Prudent management. Let's look at the most recent 12 months. I did remember seeing some, so the most recent 12 months or last 12 months, even though they had quite substantial jump in their revenue, but operating cash flow has been negative thus far. Obviously the year has not ended, and a big contribution of that negativity comes from this change in accounts receivable. You see, even though they made 19 billion as of trailing 12 months, 3 billion of that is in receivable. That means they've not received payment from this sale that they've made. So as an investor, we should be paying attention to items like this, because you want to determine whether it's a one-off problem or is it a sustainable problem for Heng Yuan going forward. There's no point making all the sales, but you can't collect a lot of these sales, and it gets piled up in receivables, and that actually impacts your cash flow very much. Let's look at their financial strength, and paying attention to the balance sheet. Cash and equivalent about 464 million. In terms of liabilities, let's look at it. Wow, total liabilities about 7.4 billion. Most recently, what caught my eye was actually them raising this thing called a medium-term notes, MTN, and it's going to be over a tenure of 30 years. The placement, the book runners will be guys like M Invest and Maybank, which will be the joint advisors. What is it for? 5 billion is quite big. Are they going to rebuild a plant? I don't think you can build an entire plant with 5 billion. That's my guess. I haven't gone into the numbers in detail, but yeah, what is this 5 billion for? Is mainly used accordingly, is used to refinance existing loans over here, fund the medium-term growth and working capital for the company. So definitely. So their most recent quarterly reports did shed a little bit of a light about their prospects. They did mention that improved revenue was due to continuous rise in oil price. 151 in second quarter 2022. And the refining margins were driven by better cracks on mogas, gas oil, and jet fuel. So jet fuel, as you know, powers the airlines that we actually fly for either business or leisure, and definitely there's been an uptick because of the opening of borders of many countries. Japan and Taiwan just opened. China with their current zero COVID policy. Hopefully by quarter 3 they really open up either for inbound travel or outbound travel, and that will really drive tourists to actually travel and increase demand of aviation and aviation fuel directly, you see. There is also a demand build up because of the sanction on Russian oil products, and that's where Heng Yuan get to benefit out of it. But is this something sustainable going forward? That's the question that we're looking for, And normal rules of economic supply demand, once you reach a supply demand equilibrium, that means supply and demand is in balance. That's where a normalization of price happen, rather than just looking at spikes. And spikes in the short term, if you're on the right side of the equation, you may benefit, but over the long term, are you going to be so precise in being able to time all this unless you have tons and tons of data to help you back that decision? So one of the upgrade projects, I thought there was a notable mention, is actually the status of the project Euro 4 Mogas. Now, if you don't know, or if you don't drive a diesel car, a lot of the petrol stations within Malaysia have started predominantly using Euro 5, which is the new benchmark standard, and is already been implemented widely in Europe. Less sulfur, less contaminant content, and what Heng Yuan used to have, the plants are very old, 20 over years old, and a lot of their units or equipment do not have the capability to blend Euro 5 standard. And with Euro 4 MoGas plant, it's actually a step in the right direction, getting them up to par to be able to produce more benchmark standard diesel. And hopefully they get this up and running so that, you know, it actually boosts their capacity as well. So having mentioned all that, looked at the finances and the prospects, what do I think are the risks involved if you were to invest in Heng Yuan? Now, obviously I told you earlier that it's a very old plant, ex-Shell refinery, Port Dickson, sold over to Heng Yuan, and they do count Shell as a major customer. Basically 85% of whatever Heng Yuan produces is sold to Shell, and they actually put them in the petrol stations where we go and pump. But the risk is that because these plants are so old, there is a question on asset integrity. So asset integrity is what is the risk of these equipments failing, causing catastrophic failure to the plant. And that's something that operationally each of these operating companies have to produce or have to put in place a very robust maintenance mechanism to ensure these don't fail. Now, obviously, most of these equipment are designed for a very long usable life, usually between 25 to 30 years. But even then, you still need to continue your maintenance program to ensure that that is actually working at not just optimal capacity, but safe as well. Now, obviously, if you drive a 30-year-old car versus a 5-year-old car, you're going to get better efficiency out of a 30-year-old car. And that's the point of me making that as a risk, because not just in terms of integrity, but in terms of efficiency as well. So the second risk is actually their project risk. Whether they had this project Euro 4 MoGas has been around for quite some time. It's had a bit of a hiccup, a little bit of delays, and these are project risks that Heng Yuan has to be able to execute to be able to overcome all these bottleneck delays and all that. And because it also impacts their capacity. Right now, they are producing roughly about their capacity. Their nameplate capacity is about 120,000 barrels of oil a day. They're licensed to go up to 156,000 of barrels of oil a day. And without these new projects coming into play, that's where they cannot boost their capacity. Because as a manufacturer, your bottleneck is how much you can produce. And if you were to break down their unit economics, it's very simple. It's average selling price multiplied by your capacity. That's where you're going to get your revenue. So unless you increase your capacity, your average selling price, you only benefit during the up cycles, but on the down cycles, you cannot produce more to offset those good days of a higher average selling price. The last but not the least risk is actually their commercial risk, in which I explained earlier, your crack spread. If you're getting very high cost input, especially your crude oil, and you don't properly hedge against your output in which you sell your refined products, that's where your margins get compressed, and that's where you lose out in terms of profitability. And this is something that Heng Yuan has to do on a constant basis, because they cannot rest on the laurels. High crude oil prices, but if they don't hedge it correctly against the prices of which they sell forward, that's where your margins get compressed. And I think these are the top three that I can think of off the top of my head. Definitely it's not an exhaustive list, but please bear in mind this risk if you were to invest. So what do I think of the long-term prospects of investing in Heng Yuan? Now, I wouldn't know what prices crude oil or refined products is going to be over the near term. It's anybody's guess. While you can back that up with storage data, demand data, and all that, you will never be able to guess accurately the movement of these prices. If you do, then I'm pretty sure you either win a Nobel Prize or you'll be a very, very rich billionaire. But more importantly, if we were an average investor or an up-and-coming investor and you want to look at a more sustainable investments, these are the things that I will look at looking at the business model. First of all, as I mentioned earlier, refinery companies always suffer from very low margins. It's very tight. And when you have very tight margins, that's where you have little room for error and a very little room to play around with. That's something that I personally don't like about the refinery business. Second thing is the volatility of the crack spreads is definitely outside of your control, even outside of any large company like Shell or even Conoco or even Exxon. You're virtually just chasing your own tail. The only way you can prevent it is just by the right hedging strategy, and sometimes you get it wrong as well. The third, I wouldn't even say it's a prospect. The third criteria that I can think of is that this is a very old facility. It's 20 over years old. While they have new and upcoming projects and facilities coming up, you are stuck at 120,000 license up to 156,000. So unless you rejuvenate the entire plant or build a new plant, which is going to be very costly, and I doubt they're going to do it with the thematic ESG keep harping on the doorway, they're going to find financing, right? I think they just have to make do with whatever old and probably not the most efficient equipment that they have today. So again, that's a negative point for me. Last but not least, if you look at the competition coming up, Petronas Refinery, they're going to have a nameplate capacity of 300,000 barrels of oil. That's almost 3 times that of Port Dickson. Do we have such a demand for the market in Malaysia? I don't think so. I think most of Petronas Pengerang refineries will be exported because a big chunk of their feedstock is actually coming from Aramco. So I'm guessing it's likely going to be sold back to Aramco. But there again, it's what I'm trying to say. They may have excess from Pengerang that they will sell to the domestic market. And therefore, that's where the competition to Heng Yuan will come in. And this is something that you have to be cognizant as an investor, because how likely are the competitors going to disrupt or eat market share from the business or the investment that you're buying into? So there you go. Those are my thoughts on Heng Yuan. Hopefully you've benefited from this video. I would appreciate a subscription, a like. I'll share with you more in the upcoming videos about how I think about business models. And if you want to learn more, hit that notification bell so you'll be notified when the next videos are out. See you guys. Bye bye.